Travillian Next is a division of Travillian, a financial services specialist search and talent advisory firm. Since inception, the Travillian team has dedicated itself to enhancing the return on investment of a company's most important resource, its people.
Welcome, everyone. Thanks for joining us today. We have what we think, and hope you'll agree, is another great webinar presentation today titled, How Being a Tech-Forward Bank Impacts Your Bottom Line. And to talk about that and much more, we have three guests that I'd like to briefly introduce to you. Many of you are also aware that we at Travillian have created the Tech-Forward Bank Index, and the companies that our three panelists represent, or our panelists today represent, are all companies that we've included in that select group of tech-forward banks. For the simple reason that they are among the clear leaders in the convergence between community banking and fintech, or what we refer to as the future of banking. So I'm Brian Love, I'm your co-moderator for today and the head of banking and fintech at Travillian, which is a boutique executive recruitment firm serving the financial services space since 1998. Yes, we're almost 25 years old. So I grew up in community banking before I joined Travillian as a recruiter in 2016. And my division here at Travillian specifically covers community banks of all shapes, sizes, and strategies all over this great country. We assist with executive search, talent advisory, and succession planning, and greatly relish the long-term relationships we've built in the industry. So please connect with us on LinkedIn, Twitter, or YouTube, and visit www.travilliannext.com to sign up for our mailing list, discover more leverageable content, and learn more about how we can help your institution better attract and retain talent. So joining us today are three distinguished guests that have emerged as leaders in the tech-forward bank arena. I'd like to allow them time to introduce themselves and their organization, so I'll keep this brief. But without further ado, please meet our panelists. Matt Dynas is president and CEO of First Northwest Bancorp. The company is publicly traded and the ticker symbol is FNWB. First Northwest is the holding company for First Fed Bank, which is a Washington state-based company that will celebrate its 100th anniversary next year. In recent years, especially since Matt assumed the leadership reins at First Fed in August of 2019, the company has embarked on a tech-forward strategy with fintech partnership initiatives, including banking as a service, digital payments, marketplace lending, and direct venture capital investments. Matt, thanks for joining us and welcome.
Thanks, Brian. It's great to be here.
Next up, we have Steve Miller. And Steve joined Communities First Financial Corporation and Fresno First Bank in California in 2015 as president and CEO. Steve's background is quite unique. So he had stints at MBNA overseas with GE Money in Taiwan in a joint venture they had with Taiwanese bank, and then for several years with HSBC Indonesia, and finally with Alliance Financial Group in Malaysia. Under Steve's leadership, Communities First, which is publicly traded under the ticker CFST, is one of the most profitable community banks in the country, with a focus in the area of payments. Steve, thank you for being with us.
Thanks, Brian. Happy to be here.
And rounding out our panel, Trent Sorbe is president and founder of Central Payments, a Sioux Falls, South Dakota-based company that is the payments subsidiary of privately owned Central Bank of Kansas City. Like First Fed, Central Bank of Kansas City has a long history as a traditional community bank prior to the inception of Central Payments in 2014. Trent has nearly 30 years of experience in the debit, credit, and prepaid payment space, and is also co-founder of Falls Fintech, a startup accelerator program that's committed to bridging the banking and fintech partnership gap. Trent, thank you for taking the time to be with us today.
Thanks for having me, Brian. I'm looking forward to it.
And lastly, my co-moderator for the afternoon is Joe Fenech. Joe is the founder and chief investment officer of GenOpp Capital Management. And prior to that, he was an analyst following banks for nearly 2 decades. Joe contributes content here at Travillian, and it's very good to see you today, Joe.
Thanks a lot, Brian. Glad to be here and excited to hear what each of our panelists have to say. So with that, we'll just jump in here and get started. So we won't have all that many questions where we ask all three panelists to respond, but I thought maybe to start off, we would ask each of you guys, if you wouldn't mind, to introduce yourself and your company in a little more detail. And in particular, if you could touch on the impetus for when you decided and what was the rationale for pivoting your business model when you did towards more of a tech forward model, and how that process has evolved over the years from the starting point to where we sit today. So Trent, would you mind maybe leading us off on that? And then maybe Steve, you could jump in after that. And then Matt, that'd be great.
Sure, happy to. It's a unique story here at Central. CBKC is a family-owned small community bank in inner city Kansas City. It actually is a CDFI. There's roughly 130, 140 CDFIs that are also financial institutions. It was really coming out of the economic crisis of 2008, 2009 that the bank sort of looked around and said, is there a way in which we can continue to fuel the growth of this institution, do the things that we're doing in the northeast corridor of the Kansas City metro, but do it in a way that sort of stays true to the mission. And so, coming out of that economic time where, I would say if unemployment in Kansas City was 7 or 8%, it was probably 50% in the neighborhoods that CBKC historically served. And so rightly, I think, they said, maybe there is something to do in this conversation around fintech and payments and as a way to attract deposits for the bank, but do it in a way that also stays true to the mission. Because as we know, so many of the products that we talk about today, have been popular with the low and moderate income community. And so it was really the CDFI mission of the institution that sort of brought us into payments. And I always say, when we started Central Payments in 2014 with the bank, we sort of grew up with fintech. We kind of came along. If you think about that time, we were just starting to think about the way in which fintech might change the financial services community. And so when we started this, we said, there's probably a model here for bank fintech partnerships, and it probably looks a little different than what we've seen historically. And for us, it was all around, let's build technology and product, and let's sort of meet fintechs where they are, given the early stage for many of them. And so I'll spare the long story, but it was really a function of the times and the unique sort of value proposition of Central Bank that got us here today.
Trent, that's a great overview. Thanks very much. Steve, how about we turn to you?
So Fresno First is a true blue commercial bank. We don't do any consumer financing. We are a single branch operation in the middle of California. I always try to explain this. There's three things that happen in this building that we work in. One is we're a true blue local community bank, shaking hands and kissing babies and sponsoring Fresno State tailgates and fun things like that. Our bread is still buttered here in California in terms of majority of customers and deposits and lending. But along with that, the second part is we're a regional and aspiring national lender. We are a big SBA lender. And we have a really good multifamily business that's based out of Los Angeles, and we're starting to spread kind of east of us. And the third thing is we're an acquiring bank. So payments is really important to us. We recently spun up our own ISO last year. So we have a national payments business. The founders of the bank, I've been with the bank for going on 7 years, but the bank's been around for going to be 17 years this year. They had run a bank before this and realized that if you're going to be a commercial bank, you don't need a branch on every corner. And I always joke on whether it was dumb luck or great strategy. We've just kind of stuck with that single branch concept. And there's some things that have kind of kept us at bay from expanding physically too much, which has really encouraged us to take advantage of technology. And I'll answer some questions later, but it's more of, technologies are not always, the latest shiny object. It's just using some existing stuff a little bit better than others. That's really helped us kind of stay on the track that we're on. So.
Thanks, Steve. Matt?
Thanks a lot, Joe. As Brian mentioned, First Fed Bank is in the midst of our 100th year. We'll be celebrating our 100th anniversary in 2023. We're really excited about that. We are up in Port Angeles, Washington, which is the northwesternmost county in the northwesternmost state in the continental United States. We did operate as a savings and loan for most of our history. We did convert to a commercial bank charter a couple of years ago. The company went public and did a mutual conversion in 2015. And, as far as when the strategy started for digital, I mean, candidly, these are ideas and thoughts that I had for a long time. I was a public company CFO for 16 years, also was a converted thrift, had done a lot with technology there and had a lot of ideas, had considered going out and starting a de novo that was going to be a digital first bank. And then had the opportunity to come to First Fed, where they had great culture, history, people, and a very open-minded board. And so really, when I went to go interview for the job, I basically pitched them like I was raising capital. They had about a 14% tangible common equity ratio, great core deposit base, great set of products and people and culture and governance, as opposed to going through the de novo process where maybe you raise $20 or $25 million and you have to operate very narrowly under a 3-year business plan that needs to be approved and blessed by the FDIC just about every quarter. This was a way for me to work with a company and really build on a community bank platform that we truly believe in and that we're committed to. But in addition to that, to delve into Fintech as an investor, as a sponsor bank, and in the case of Quinn, as a joint venture partner, where we are literally, arm in arm working with a Fintech in a way that we think is pretty unique compared to a lot of other banking as a service opportunities that are out there. But in addition to that, we do offer traditional banking as a service and have recently started in a partnership with a company called Splash Financial, and we'll move into other partnerships that will be announced in the coming months and years.
Thanks, Matt. Obviously, some varied backgrounds and company histories that led you all to this point. Trent and Matt, maybe your organizations, as Brian touched on earlier, both have really long operating histories, right? Steve's a little more Fresno First, a little more recently started 17 years ago. One thing I found in digging in deep on tech forward banks is that while tech itself might not have been a focus for very long, there tends to be something in the DNA of a lot of these companies that made the business model pivot a little easier. Was that the case at your organizations, or has it been a complete overhaul? And if so, what was the specific process like for getting the employee base on board with the strategy, and then also the board, which I think at most community banks doesn't tend to be the most, if I'll say technologically nimble. Matt, maybe if you can respond to that, and then Trent, if you wouldn't mind weighing in on that as well.
Well, as I mentioned, when I came on board, I had these conversations with the board about what my intentions were, and had a 4-pronged strategy that related to leveraging the balance sheet, bringing in the best people, holding them accountable, empowering them to do their job, and rewarding them when they did really well. And then also had some goals around data, and then around Fintech and technology. And so they had implicitly or explicitly bought into what I said I was going to do. And as I continued to do these things and bring these things forward, I tried to refer back to those conversations as to what our plans and intentions were. We're true believers in the concept of the power of and we really think that we can continue to operate as a leading community bank in the state of Washington, as the #1 market share in Clallam and Jefferson County, as well as be very tech forward, and that there's opportunities for both the Fintech activities to lean on the bank, and also for the bank to learn from and benefit from some of the Fintech activities. And that's really how we've done it. We've had really strong retention on our team. We've been able to win the Best Workplaces Award in the state of Washington from the Puget Sound Business Journal the last 2 years. So we've really tried to build on top of and alongside of the existing team and infrastructure. And I think it's gone quite well. I will tell you that culture is incredibly powerful and incredibly important, and it really drives everything that we do in the organization. And as I reflect back, there's certain things where we still have a ways to go. But there's so many great accomplishments that we have to lean on and to look back on. And we see this for the foreseeable future. I've talked to other Fintech banks, and, there could come a point in time where you're like, hey, we're going to have to choose one path or the other. I think we're a long, long way from that. I hope that we never have to go down a path of having to choose. But thus far, it's gone really well. I think that we've learned a lot during the process. I've had a lot of our great employees step up and do tremendous things. We've also brought in some incredible talent across the country, really, who have helped us to augment our journey.
Thanks, Matt. Trent, would you mind weighing in on this question?
Yeah, absolutely. It's been interesting listening to Matt and Steve because I can relate to points they've both made. I go back and I say, you know, I give the board at Central Bank, and again, we're talking about a family-owned bank by the same family since the 1950s. I give them a ton of credit by, you know, they basically came to the hard realization that they're under leveraging their platform. And when I say platform, I don't necessarily mean the technology platform, but where banks sit in the ecosystem. Functionally, the charter is effectively a platform. And they recognized they had an overdependence on their core. And they recognized that the only way they're going to stay in Northeast Kansas City, very, very economically distressed neighborhood, the only way they're going to stay there and serve that community is they find new revenue streams. And so it was really a combination of those things where they recognized that, look, I'm not going to be able to compete on product that I have to build. I'm not going to be able to compete on branch footprint. Maybe I need to understand, maybe I need to accept that reality and focus on infrastructure. And I think that made my job when I came in 8 years ago so much easier because the board at that point had said, look, we have to leverage this infrastructure because that's our competitive advantage in all likelihood. And so we need to do something with this. Now, when we came in, we said the first thing we probably aren't going to be able to do is change the way at that time 70-year-old community bank had done things inside 1 or 2 branches or offices in Kansas City. So we said right away was, look, we're going to have to build out a team that has specialization, and that's why, you know, we're in Sioux Falls. You know, I think most people would say Sioux Falls is not a mecca for many things other than hunting, fishing, and the card business. And I think we quickly realized small community, a lot of us knew everyone in the community. We knew the team, we knew the people that were here and the skill sets that were here. I think I heard at one time, 70% of the prepaid cards are issued out of Sioux Falls today in the United States. So it was really a function of saying, okay, we're going to have to build this out uniquely. It wasn't like we were trying to make a lot of difficult concrete walls between inside the organization, but it was more of a realization that talent rests here, and this is where we need to invest versus trying to change the mentality of what was going on inside the branches in Kansas City. And we just happened to be, you know, very lucky to be in a position here in the Sioux Falls market where, you know, the talent level is very high for the type of business that we are in. And so, you know, I'll put that all together. You know, we've grown Central Bank into the 17th largest prepaid card issuer in the country. We sit right in between Wells Fargo and PNC. Now, most people would say Central Bank of Kansas City shouldn't be on any list in between Wells Fargo and PNC. But it gives you a sense of the way in which we've been able to take that platform idea that the board came in with and really leverage it and do something with it.
Interesting, Trent. You talk about the longtime family ownership. Just interested in your opinion. Do you think that pivot was easier as a private company and closely held? You know, maybe one or I don't know the composition of the family that you know, maybe 1 or 2 family members going back to the 50s. You said making that decision, was that easier than, oh man, we're a public company, how do we communicate this 100% 180 pivot, right? From what we've been telling people. Do you think it was easier?
Yeah, I think there's 2 things. You touched on that. Family owned since the 1950s. There's effectively one guy. And when the one guy is an entrepreneur and he wants to do something, things tend to fall in place very easily. And I give him a ton of credit for that. And then also, the bank had built up a ton of regulatory capital. You think about a CDFI. If you drew a 5-mile circle around the main office of Central Bank of Kansas City inside Kansas City, I'm not sure you'd touch another bank. It'd be close. And so you build up a lot of regulatory capital when you're serving that community. And of course, it doesn't hurt that you're well capitalized and, you know, all of the metrics are there as well. But, you know, I give them a ton of credit for recognizing, hey, we've got some regulatory capital. We're doing really good things in the community, outstanding CRA since the mid-1990s, for heaven's sakes. How do we put all that together and think about the next stage for the company?
Great. Thank you for that. Steve, your situation at Fresno First, a little different in the sense that the bank was started only a decade prior to when you came on board as CEO. It wasn't like these other guys with 70 and 100-year histories, right? What was your experience like in that regard? Was it still somewhat of a blank canvas where you felt like you maybe had the opportunity to start from scratch in a sense with a decade-old de novo, or was it a heavy lift to change the culture?
Yeah, I mean, I wouldn't call it a completely blank canvas, but at that point, we were one of the last banks to get the charter before the crisis, and we got stuck in de novo for a long time. They made some poor decisions in terms of senior leadership that caused them to sputter along for a while. But it was a great bank when I got here, and I reminded the board. I said, "Hey, you're the ones who made all those mistakes earlier, so you got to give me a little bit of time." But they took a chance on me. I'm not your typical community bank CEO. I have a consumer, international payments, and commercial background, so a little bit of everything, but definitely not a master of anything. The best thing about it was our board, all entrepreneurs, all small business owners, no bankers or lawyers on our board, which was a very funny passion project of our previous chairman. And he actually grew up in the estate planning kind of ESOP world, and has always been a bit of a cowboy, and so because of the board support and the entrepreneurial spirit, we're set up as an ESOP, so everybody in here from the earliest teller all the way up to me as a shareholder of the company, that ownership and that stake in the outcome is really, really important to us. And when I came on board, I told the board, I said, "Hey, every day we wake up, we've got a bank charter and an acquiring license. There's only 59 other banks that get to say that when they wake up each morning." I go, "But you're not leveraging either of those. So, let's figure out what to do." And so there was a bit of a mind shift, very similar to what everyone else talked about. At the end of the day, we're still a community bank. We still are. And we're still a bank. So there's things you just have to do. And there's a mindset there. But we were able to bring everyone along. And I think today, between all of that and also with COVID, we kind of look at the country as our canvas now. We have customers in 37 states because of our payments business. We recruit people across the country, we recruit customers, and now our potential partners can be in all 50 states. So, that's just kind of the way we look at the world. And I think it all started because our board, had a pretty open mind about things. So.
Thanks for that, Steve. Appreciate that. And Trent, I had another question for you on culture, if I could. And then Steve and Matt, you can add to this as well if you'd like. Feel free to chime in. So many tech-forward banks have talked about striking that balance between not allowing the traditional community bank operating philosophy to seep into how the Fintech division operates and grows, but on the flip side, also not wanting to have it exist as its own silo entirely apart from the rest of the company. Can you talk specifically about how you manage that process at Central Payments, which is a subsidiary unit of the bank?
Yeah, I'd love to tell you that that was easy. It's not, as you can imagine. I think one of the things that really helped was we elevated the payments business to the point where I know organizationally and legally and structurally, it is a subsidiary of Central Bank of Kansas City, but we really look at it as a business line, right? And we have really three main business lines: commercial banking, our CDFI, new markets tax credit work that we do relating to our CDFI certification, and then our payments business. We elevate all of those equally within the organization and recognize everybody is dependent on the performance of all three. I think one of the things that made a lot of sense is, each of the heads of those lines of business sit on the board of directors of the bank, including me. And so I think that necessarily creates a way in which all forms of the business are equal, right? We don't look at one as being particularly dominant over the other one. These are just three lines of business that are key and depend on each other for the overall organizational success. So I think a lot of it had to do with some of the structure that took place. And I think, we find ourselves being able to help out the community bank operations a lot, especially as I think about new technology they want to bring to some of in the local market there in Kansas City, and things that they probably weren't able to do because the expertise wasn't there. 8 or 9 years ago before we got there. And so we can leverage some of those relationships and help them drive, product development inside the branch that probably they didn't have to, because going back to what I said before, there was such a reliance on the core. And so I think all of those things over time created a culture that the organizations just found a way to work together nicely, despite the fact that community banks in Kansas City and payments businesses in Sioux Falls.
That's a good point, though, Trent, how technology can help all parts of your bank, not just your fintech division. We see it at a lot of our clients as well. Steve, did you want to chime in on that question?
Yeah, I think that, the bigger you get as a bank, you can't avoid having expertise in some silos. And when you do things like this, you just have to do that. I think that where you want to spend a lot of your time is just making sure that you can't expect everyone in the bank to be a fintech junkie and to understand API details and all that stuff, but you have to give a base knowledge for everyone to understand, so they're on the same page as why we're doing certain things, and give them the opportunity to learn and to dig in if they want to. But yeah, I agree with Trent. It's hard work, and that's why a lot of people don't do it. It's easier not to address that stuff and end up with a bunch of silos that don't talk to each other. So it does take time to make sure that everyone's on the same page. Maybe not the same expertise level. That's impossible, but you got to be on the same page as to why we're doing the things we're doing.
And Matt, anything you'd like to add there to that point?
We created our own division within the bank called First Fed Fintech Partners, or F3P, and that is a distinct group of employees led by our Chief Operating Officer and now Chief Digital Officer, Chris Riffle. Chris also has the operations, IT, compliance, and risk reporting up through him as the COO. So there's a synthesis between his direct reports, and they do correspond and collaborate all the time. And so there's still a really nice synthesis there. I think as we grow and we build that out, I think Steve's point is a good one. You do need experts, you need specialists. This stuff is hard to learn, and there's really great people out there that you can bring on board that can really add to your subject matter expertise as an organization almost overnight. And we found that so far, and we'll continue to build on that. But, we want people to feel like it's one family, one First Fed, and we continue to look and act that way and let people know. I think the traditional bankers that we have at the company, I think, want to know, like, hey, what about us? Do you still care about us? And so, we do. We need them desperately. We care about them desperately. We still participate in so many community events. It's just a matter of keeping that emphasis and that alignment. One of these guys mentioned the new shiny thing. I think in our pre-meeting, it's true. Like, how do we avoid from just getting that, squirrel, like, oh, there's another opportunity. Really staying focused and understanding that at our core, we're a community bank. It's just the definition of what our community is likely going to change.
And thanks for that, Matt. I was going to move on to banking as a service. And this question is for you, Matt, to stick with you here. So there's a lot of banks in the country that have got into banking as a service. Now, actually, the number we have is probably somewhere between 60 and 100, but that number is probably going to multiply as we go into 2023 and beyond. How should we as outsiders differentiate the meaningful players from the ones that are just looking to put their name on a package and call themselves a tech-forward bank? What are some of the specific characteristics of these business models that we should look for? And what questions should we be asking? And then can you weave that answer, into the differentiating aspects of the First Fed BaaS offering?
Well, this is really simple, Brian. Anyone that's in the Tech Forward Index is in that group. No, I'm just kidding. It's interesting. I think ultimately you have to look at, are they developing the core competencies? Are they demonstrating that? And ultimately, are they successful at it? And are they committed to it? If I look at the two banks that are on the call with Trent and Steve, I mean, these are high performing banks, 2% ROAs, really strong and profitable. They've leveraged into these new strategies and technologies to really be profitable. You see other banks across the country who are participating in this space, and they are seeing outsized returns and outsized performance. And ultimately, the reason for that is this is a relatively capital light business strategy. If you look at our traditional banking strategy, it's all based on leverage, constraints of capital, liquidity, concentrations, all of the things that we have to deal with. in this fintech world and in this payments world or other types of non-interest income world, you don't have those constraints. You have operational constraints, you have capacity constraints, you have regulatory constraints. But realistically, there's an opportunity here that I think is outsized. The challenge is it's tough. This is really hard, and I'm not trying to dissuade anyone. I hope people that are listening that are interested continue to pursue this. But it's difficult, and I do think there's a moat for some of the banks who have gotten to the other side, including the gentleman on this call. And so it's going to be really interesting to see how that continues. The banks that are committed to that, it's going to take committed boards and committed entrepreneurial leaders. And too many banks, unfortunately, do not have those ingredients to be able to really go on this journey. And it starts with the boards. I mean, it's easy to say, well, the CEOs or whatever, like the boards hire and fire the CEO. It's their job. And so if there's banks and boards and shareholders that want to go on that journey, they've got to identify that leader that's willing to take them there.
Great thoughts, Matt. Thank you.
Thanks,
Joe.
Matt, and apologize all for my technical difficulties earlier. But Steve, how about a similar question for you from the payment side? You've talked a lot about how you've gone about building your payments ecosystem. Can you maybe talk to us about the differentiating aspects of the business you've built relative to maybe how some others have approached building their payments business?
Yeah, look, I think there's a handful of people that have a similar license to us and have been in the business a lot longer and probably do it a lot better. But we just looked at the payments business. When we think about fintech, we think 90% of fintech is, no offense, but kind of garbage. And there's a lot of noise in the market and takes you a lot of time to kind of weed through. Most fintech is still online consumer scored lending. I was doing that back in the mid 90s. So I think where we see fintech is really, we're bankers. We move money from point A to point B, which is all payments and treasury management. So we think that's something that we want to focus on going forward, whether it's B2C or B2B. And we have this asset, which is our acquiring license, that, hey, this allows us to safely get a seat at the table and really understand some of the big shifts that are happening in the financial services industry. And that's really what we look at. And specifically what we refer to as a payment ecosystem is, we act as the acquiring bank, you can act as a bookie and basically take a vig on every transaction. The way the rules are set up, you sit behind the scenes. Or you can get closer and closer to the merchant. But the ISOs that we support are not banks. They're the ones who have the relationships with the customers. So through one contact, how do I get access to their 50, 100, 200,000 merchants that I can then do deposits and lending with and other financial services that my partners can't? On top of that, the card brands and the different people within the payment kind of food chain need to come to an acquiring bank. And they're looking for a really good acquiring bank. It's very similar to why a small business owner comes to a small business bank. They want to have a seat at the table with the decision maker. And all your payment partners are the same way. They want to be able to talk to the senior people, specifically the CEO of the bank that's supporting them. And I probably say Trent probably has the same experience. Like, I have a customer always jokes, when you call Wells Fargo, you're not going to get Wells or Fargo on the phone. But when you call Fresno First, you're going to get Steve on the phone. And we treat the payments business very similar to how we treat, a local restaurateur here in Fresno. We're going to give them that high touch service and relationship. And we think that's really the approach that makes us different. Now, specifically, we have the acquiring license, but we also have high brand risk transaction capabilities with Visa, and we actually use it. So we can support any customer or partner to do ACH, debit, credit, both high risk and low risk, and very few banks are willing to do that. We have a very different view of risk tolerance, and that makes us unique in the market right now. So,
very interesting. And I definitely want to come back to your comment about 90% of fintech being noise. We'll get to that a little bit later. But for now, Steve, maybe just a follow up to you that speaks directly to the title of the webinar today. You operate one of the most profitable publicly traded banks of any size in the country, let alone small banks. There's any number of things I could point to that contribute to that profitability. You got a 4% plus NIM. I think non-interest bearing deposits are something like almost two thirds of your deposit base. You operate out of just the one physical branch location, which I'm sure helps from an efficiency perspective. And you got a diversified revenue stream. I think merchant services income from the payments business, about half your fee revenue. My question is, do you consider the tech forward aspect of what you do to be the secret sauce of that superior profit profile, or is that maybe overstating things a bit?
I think it really, if you strip out payments, we're still a really good bank, one of the best in the country. So I think payments is just going to be the icing on the cake in terms of fee income. I think the usage of technology and understanding what to use and leverage and avoid, and that goes all along with being that single branch operation. It kind of forces you to, I always equate us to the country of Singapore. Singapore is this teeny little island that's like the most profitable country in the whole world because they had no choice. Right? They had no water. They had to figure out things on their own. And we're kind of like that. We've decided to keep our one branch and figure out how to continue to expand our radius around us. So I think that attitude and all that is really what helps feed the efficiency part of the bank. And we run not just a lean shop from a branch standpoint, but if you look at the size of the portfolios that our deposit managers run, for instance, they're 3 or 4 times the size of most community banks. And when I came on board, I kept on hearing, oh, well, we're really, we're top 10% in our peer group. I'm like, well, that all depends on who your peer group is, right? So we looked at the very first strategy thing that I did when I came in was, what do the top 1 or 2% of community banks look like? And the commonality between all the banks was that they were about a 2% ROA or more. They had a focus. They weren't trying to be everything to everybody. They had a couple niche businesses that they really did well at and focused on. And I said, okay, that's the goal. We need to be in the top 1%, which is the top 50 to 100 banks in terms of performance. So that was really the drive for us. But I always go back to, look, I learned commercial banking from a bunch of stodgy Scottish guys at HSBC. So you hear us talk about things, it's always deposits. It is the most important thing in any person's goals is getting new customers, growing your top line new customers on an annual basis, and getting operating accounts for small businesses. And even with payments, we're in the payments business because I want deposits. And that's really what the focus is, the bank, because at the end of the day, I don't want to be a one-trick pony and be 100%, one thing. I would love to have the same, non-interest bearing deposit ratio, and have a 2% plus ROA and a 25% ROE, and 40% of it be fee income. That's just a great bank. So how do we maintain that as we grow along? I don't want to be 95% merchant services. The bank has to keep up with the payments business and so on. So.
Yeah, thanks for that, Steve. I think you had mentioned Trent in your response before, and he may want to chime in with something now. Trent, if here's a good time.
Yeah, I think I love what Steve just said. I'm about deposits, and I started my career at the FDIC. I spent my first 10 years at the FDIC, and we would have these nerdy arguments at holiday parties and stuff about like which of the camels ratings is more important, right? And I always would come back to liquidity. And I think it plays into the conversation of how do you create camaraderie within the organization if you have this sort of fintech focus over here as well as your community banking. What I always say to the commercial loan officers is like, look, I'm going to flood you with free deposits. It's up for you guys to do something with it because we all live off the NIM. I'm half the NIM, you're the other half. And you better get creative because I'm throwing a ton of free deposits your way. So you're out of excuses now not to find loans if your cost of borrowing is 0. And so it creates an interesting camaraderie within the organization. It creates interesting ALCO meetings when we start to think about that. We have a big advantage now. Let's do something with it. And I'll just touch on, we talked about this whole concept of bank as a service. I love to talk about what real bank as a service is. If you, and I think Matt talked on it too. If you call us, you're going to talk to your technology provider, your compliance people, the executive management team, and product people, all on the same call, all getting the same paycheck from the same organization. And so if bank as a service, and if that's a label for some organizations, if it's really just another concept of what we used to call sponsor bank, I don't think that's bank as a service. If you have to call if you have to call an intermediary because they're your technology provider, it's going to be really hard to consider yourself bank as a service. And so as we think about, and I'm watching, these labels get thrown around so much, that's why you're going to see us talk about real bank as a service, because, we are the technology provider, just like we're the compliance provider, just like we're the product builder, et cetera, et cetera. And, I think another thing is if there is an intermediary, let's talk about the intermediary. Let's talk about the financial condition of the intermediary. Let's talk about putting a lot of eggs into a startup who's you basically inserted right in the middle of the infrastructure of whatever it is the fintech is building on top of you. I think that's a big factor. And I think a lot of people would, to be able to say, like, look, the infrastructure is sitting on a 70-year-old community bank owned by the same place with a, 25, 30% capital, doing a 4 ROA, that should make you much more comfortable about building businesses on top of, about building how you're going to build the business. It's foundational. If in turn you're going to say, look, I've got this third-party bank over here, really don't want you to talk to them if I could at all help it. I'm a startup. I'm not even sniffing profitability yet. That all feels really tenuous. And so I think as we talk about, bank as a service is foundational. The charter is foundational. The platform is foundational. I think Matt and Steve are saying the same thing. That's where I think distinctions start to come to light very, very quickly.
That's an interesting perspective, Trent, and I'll come back to you right after this question for Matt. And this subject is more about building versus buying. So it's somewhat related to what you're saying. So when banks go the route of pivoting their business model towards more of a tech focus, there's always a debate about build versus buy, whether it's systems, talent, whole companies, vendors you choose to work with, et cetera. Can you take us through the process, Matt, when you went through at First Fed to determine what was the right thing for your organization? And then how has that process evolved and will need to evolve further as you move forward?
Well, it's a little bit of both. I mean, when you think about buying, it really depends on what you're talking about. If you're talking about a whole company acquisition or a whole entity acquisition, I think that's one thing. But if you're talking about, like we've done, investing through some of the venture funds, if you're talking about investing directly in some of the fintech partners, which we have also done, in a way, we're buying those companies. We're not buying the whole thing, but we're buying into those companies. But by and large, it's really a build proposition. I think that's where the long-term value is. We've started to have conversations recently about, well, are there good fintechs or good tech stacks or good tech teams that are out there that are now either wounded or trading at a huge discount to where they were 6 months ago? The answer to that's yes. Right. But, what's good that's underneath there that's left that might be interesting for us to partner with or acquire, or to maybe just try to do a lift out. We think about this in banking of doing a lift out of commercial banking teams, but what if you did a lift out of technology teams? And I think that's going to happen soon, because a lot of these fintechs, I tend to agree with Steve. I think there's so many of these companies that don't really have a great business model. It was tied to interchange, or it's tied to risk-based, lending off of FICO and a few other things that they think that they've got some sophisticated AI or machine learning model that we haven't really seen bear out. The FICO scores are actually pretty good. I mean, they've been around for a long time. They're tried and true through different economic cycles. So, I tend to agree with what Steve said there. And I think we're starting to see that play out in the markets. I think when we're looking at these tens of billions of dollar valuations of some of these companies, you're thinking like, what am I missing? What did we do wrong? But now I think you're kind of looking at where the stability in the industry is, whether or not it relates to lending, whether or not it definitely relates to deposit gathering, or whether or not it relates to payments. And it's coming back to the banks who have the charters, who have the expertise, and who really have the capabilities to take advantage of what's coming on. Because my thesis about what we're trying to accomplish in fintech has not changed at all. I feel more strongly about it now than I did before. But there's a lot of people that are abandoning ship, and there's a lot of, there's been a lot of value destruction. If you think about crypto and some of these other areas, I mean, it's pretty remarkable to see how messy it's gotten.
Yeah, and Matt, I mean, it's obviously a lot of opportunity with these market conditions, it sounds. And Trent, I had mentioned I wanted your perspective on this as well. And, you've been building since 2014. I remember in an earlier conversation, you were telling me all about it. Buy wasn't an option back then. So on the one hand, I can see that as limiting from an optionality perspective, but on the other hand, I'm sure you gained some valuable experience in the sense that you had to figure things out on your own, which kind of, I would think, puts you ahead of the game relative to your peers. Can you just share your perspective on that?
Yeah, I mean, I think you touched on it well, and I'm going to throw some kudos to Steve as well. Steve said, you know, they're trying to get closer and closer to the merchant. We're not that different. We're just on the other side of the transaction. We're trying to get closer and closer to the cardholder. Either way, it benefits both of us to be, you know, closer than where most banks historically have been. And I love to go back to this concept of build versus buy and rewind the clock to about 2018. I mentioned the one guy, right, at Central. You know, I went to the one guy and I said, let's build this thing. And he's like, what? You know, we're talking millions and millions and millions of dollars. And so he and I would arm wrestle philosophically around how we do this. And we ultimately came back to okay, we're not necessarily going to build it entirely in-house, but we certainly aren't going to buy it. What's the difference? Well, maybe it's a rent-to-own type thing. Maybe we find some folks internally that or externally that we know. We work out some rent-to-own type arrangements, and let's see how the market reacts. And you know, while I wish we would have just built it from scratch with our own team, I can understand why the rent-to-own was the way we went. And then when we started to see the market reaction, now we find ourselves going back and saying, okay, the thesis, to use Matt's word, is starting to prove itself out. Maybe at that time it was a hypothesis. It's proving itself out. Now it's time to shore it up. Now it's time to leverage it. Now it's time to expand it. Now it's time to reach scale, because the rent-to-own model has served its purpose, and now it's time to really make it your own. And so, you know, we did that through, you know, the latter half of the decade, 18, 19 into 20, and then we spent all of 21. Now that we had comfort, investing in and making it scalable. And so I think that's a natural course for a smaller community bank to go. I would have loved to have had the $20 million check back in 2018, but you can understand why, you know, it's a walk before you run approach. And I think it has, you know, it worked out well, because I do believe that, you know, you're talking about a small number of banks out there that are in a position now to say, no, I don't need a startup infrastructure play that, you know, doesn't feel particularly good to me, particularly in the economic times that we are, where we know they're going to have to come back and raise money just to continue the cash burn that they're on. I'm glad I don't have that. I'm glad that, you know, we can still drive the direction of the infrastructure, because I think over the next 2 years, to I think Matt's point, we think opportunities are going to roll back this way, and we're going to see, you know, the market correction really prove out that, you know, if I want to be closer and closer to the cardholder, I better be closer and closer to a bank. And I think ultimately that's where our thesis is, and reducing reliance on middleware that, you know, feels pretty tenuous, and reducing reliance on core providers that, you know, are going to be slower to react. And we think, you know, we feel really good about being somewhere in between there.
Matt, as we run short on time here, just wanted to maybe hit on this next topic in terms of tech forward banks and performance measurement. You know, tech forward banks tend to look at some different metrics and milestones to measure their progress and success, and they might differ from sort of the standard measurements that we typically use to analyze community banks, like ROA, ROE, you know, what have you. What key metrics do you look to? Does the board look to? Your investor base, you think? What are the metrics that are important? And then what are some of your specific goals and objectives for First Fed over the next 3 to 5 years as you build this out?
So, you know, as a public company, we're really focused on a couple of things. First of all, revenue growth. You know, we look at ourselves as a revenue growth company. You know, most bankers, when you talk to them, and the first question you get is like, oh, how big are you? What's your asset size? And that's fine. And I think that's important and gives you potentially scale or whatever. And there's ramifications as you get over 10 billion or larger. But I also really look at our growth in revenue, our growth in earnings per share. Some of the things that Steve talked about. I mean, I would love to bottle that up when you're talking about this over 2% ROA, over 20% ROE. I think those are really what tell the story. But I do think that it's difficult. It's difficult for bank investors to really look at this because they potentially see risk. A lot of community bank investors know what they like and know what they've done well with. And so they want to see that. And so transitioning from that traditional model where you're looking at certain metrics, even NIM. I mean, of course we care about our NIM. I care more about net interest income in dollars. And so, those are some of the things that we look at. And we're certainly trying to evaluate our expertise as we get into the fintech space, the number of new partners, the revenue from those particular endeavors, and the long-term opportunities from those endeavors. Those are some of the things that we're largely focused on.
Great. And Steve, I wanted to come back to what you said earlier about the 90% noise comment on fintech. One thing that's concerned me a little bit in surveying the landscape of what we call fintech is it seems to me in every marketing slide deck, all you really tend to see over these past several years are market share targets, lowering the cost of customer acquisition, scale, and all of which are important. But what I've not heard a lot about in the typical marketing pitch deck for a fintech or, whether your underwriting standards, credit workout capabilities, how you might be positioned for a downturn. And maybe I'm coming at this with too much of a crusty old bank analyst eye, but, as we head into maybe a more challenging environment here, is this something that worries you? And if so, how do you think this plays out from here?
Well, I mean, I look, at the end of the day, we still are crusty old bankers. We have to be because, we have deposit insurance and regulators and different people that are our stakeholders in our success. So I think that's important not to forget. I think the other thing is we're also in the business of time. I mean, we're in the business of compounding, and time heals a lot of things. So as bankers are typically pretty patient, and I think Matt and Trent were talking about these cycles that they go through. So I just think there's a lot of noise in the market. I went out and hired a guy who's my fintech VP of fintech partnerships, just to kind of weed through it because I didn't have time to sift through there's more fintechs supposedly than banks, right? So, and one of the things that he came back to me about 3 or 4 months into the job, he said, and he comes from the startup world. He's like, he goes, if you're going to give these guys money, just give it to me. We'll go hire a couple full stack developers and build it ourselves. And I was like, interesting. Now, and then at the same time, if you go to our website and look at our chat bot, it's cost us $900 a month because it's some off the shelf thing from Intercom. So, you got to understand where you can rent to own and just rent permanently, and versus where you're going to invest to build for long term. But I just think that, we have to take a much longer term view of the horizon because of the fact that we are still banks, and what that gives us is, a little bit more patience to let the market handle the week. And then when the people are left, you've got some good partners that are left. And I agree with Matt. I think, man, I hired a 20-year veteran of startups who's my CMO and kind of chief revenue officer. And he came to me one day and he goes, man, Steve, this is great. We make money every day, don't we? And I was like, yep. I'm like, and we're one of the best. I go, and that gives us a huge margin of error when you're profitable. I always tell regulators, I'm like, forget about capital. If we're talking about capital, it is over. I'm like, my first line of defense, I'm a business. I have to make money. And when I make money, I get to do all the things that Trent and Matt were talking about. You get to invest, your board has confidence. So I agree. I think you got to have a profitable core business, and then you can go play in these different sandboxes. So
great. No, that's great. And Trent, maybe just quickly from you, many different aspects to the business, obviously here. If for a second we thought about fintech though as a monolith, right? In ballpark terms, put on your analyst investor hat for us quickly, if you wouldn't mind. How far would you say we are through this correction or bottoming process or whatever you want to call it? And what do you need to see happen that would convince you that we're through the worst of it?
Yeah, I'm going to answer the question by picking up on what Steve said. I mean, we have got to find a different word for capital as it relates to most fintechs in this space, because it's not capital. Capital, there's an absorption component to capital, right? Ride me through a difficult time. using cash and burning cash, that's not capital. And so let's call it what it is. And so I think, I don't think, if I'm going to put my analyst hat on, I think we are going to have this conversation for another 12 months at least. And I think the market is going to correct the week. To use Steve's line, I wrote it down. I'll be using it again, Steve. Thank you very much. But I think we're going to have this conversation for a long time. And I think that's going to get really, really exciting for folks that like to invest in banks, because it is going to roll this way. Innovation isn't going to stop. I think what might change is we start to think about whether it's fintech innovation or it's embedded finance innovation. I think that's where we're going to watch the market. The folks that are sitting there thinking about embedding financial services inside of existing distribution with big brands who can absorb the downturns in the economy that we expect to continue over the course of the next 12 months or so. That is where I think innovation is going to happen. And I think all of that's going to roll back to banks that have a platform for embedded finance to build on top of. And I think that's going to be exciting to watch as the market corrects early stage fintech and the difficulty in their cash burn. I think it's going to roll right into the embedded opportunities, and all of the embedded opportunities. None of them want to be banks or bank holding companies. They're going to want a one-stop shop bank partner who can do more. And that's why I think it's going to get pretty exciting over the course of the next 12 to 18 months.
Matt, it's such a pertinent topic, obviously, with what's going on in the market. But, one of the common, I don't want to say impediments, but challenges for tech forward banks, the past few years has been talent acquisition and the cost of talent, finding that talent, competing with the gleaming, cool fintech office tower in San Francisco, right, where everybody wanted to work. Is that becoming easier? Has that process, have the tech forward banks kind of moved to the forefront here in terms of competitiveness in the war for talent because of what's happened in the market, or is that still to come, in your opinion?
I think it's a combination of being tech forward, but also the leaders. I mean, you look at Steve talking about hiring people out of startups and others, and the people that want to come work for him, or Trent, being in South Dakota and really understanding that that's where the ecosystem for prepaid cards really exists. And I'm sure they're drawing great people and great talent there. We've had relatively good success in finding the people that we want and that we need. It is still tough and it is costly. I mean, there's no question that the market for someone who has that kind of technology background, the expectations for salary is much higher, and the market for those salaries is much higher. So that does make it challenging. It's interesting. I do pinch myself. We have 3 employees that live in New York City. I mean, I it's just, to me, I don't know exactly how that happened. They're amazing people, as are the people that are from Port Angeles. But it's really cool to think about as we open up our horizons. Steve talked about having a national footprint. Trent and his firm do broad things across the country. To think about what we can do when we open our horizons. It doesn't mean we're abandoning or leaving our existing markets, but it just really opens up where we can come and how we can reach out to the world. One other quick thing I wanted to say, Steve was talking about this. I used to tell my team, stop thinking like bankers, because, it's very hard to get out of that mindset. But I will tell you that it is a core competency that is invaluable. To have that mindset, whether or not it be from compliance or how the payment systems work, how credit works, being a banker is critically important and tremendously valuable. And that leads to, not having to worry about, the only banks you ever hear about worrying about their cash burn is if they're like a 4-rated bank that's on their way out towards being taken over by the FDIC. But other than that, that's not an issue for banks. We have tremendous free cash flow. Hopefully we can generate that from deposits, but the real value comes from generating that through earnings.
Yeah, Matt, that's, everything you're saying about talent previously there, obviously that's my bailiwick, and definitely a premium for that tech forward talent. We are seeing a lot of our clients lean into the remote piece as well. Now, we are just about out of time here, and I feel like it's still tip of the iceberg. There's a lot of topics we didn't get to. So hopefully we can meet every Thursday at 3:00 and do one of these with all you guys again. But I guess we will adjourn for today. And I really just want to thank Steve, Trent, Matt, so much for being with us today, sharing their insights with our great audience today. Thank you all very, very much. Also, everyone, please visit TravillianNext.com to learn a little bit more about our business and subscribe to more content. and contact me and my team. But thanks so much for everyone for being here today. And thank you to our panelists again.
Thanks, Brian and Joe. Have a great day.
Thank you so much, gentlemen. Appreciate it.
All right, take care.
Bye-bye.